Money feels neutral, almost boring, like a simple tool we use every day, but what if I told you money is one of the most powerful weapons ever created, shaping empires, destroying nations, and quietly controlling your future without you even noticing? We assume money evolved naturally to make life easier, yet behind every coin, bill, and digital number lies a trail of power struggles, wars, broken promises, and calculated deception. If money is just paper and numbers, why has it caused so much bloodshed? And why does it still decide who wins and who loses today? Welcome to Meta Finance Lab, where you can get more informative videos related to finance. You can subscribe to the channel for timely updates. Today, we are going deep into the dark history of money, from shiny pieces of gold to invisible credit systems, and by the end of this video, you may never look at your bank account the same way again. Stay with me, because the biggest twist comes much later, and it directly affects your daily life. Long before banks, governments, or credit cards, money did not exist at all. People traded goods directly, exchanging grain for tools or animals for shelter. This system worked in small groups, but it failed the moment societies grew larger. Imagine needing shoes but owning only cows, and the shoemaker does not want cows. Trade stalled, trust broke down, and growth slowed. This problem created an opening, and someone eventually realized that power could step in and solve it, but not for free. Gold and silver became the answer, not because they were magical, but because they were rare, durable, and hard to fake. Kings and rulers quickly understood something critical: whoever controlled gold controlled trade, armies, and loyalty. Coins were stamped with faces of rulers, not for decoration, but as a reminder of who guaranteed their value. Here is the question most people never ask: what happens when the ruler breaks that promise? The answer changed history, and it happened sooner than anyone expected. As empires expanded, wars became expensive. Roman emperors needed more money to pay soldiers, so instead of finding more gold, they quietly reduced the amount of precious metal in coins. The coins looked the same, but their value was diluted. Prices rose, trust collapsed, and citizens paid the hidden tax through inflation. This was not an accident or mistake. It was a deliberate strategy, and it worked until it didn't. Rome fell, but the tactic survived. Centuries later, gold returned as the backbone of money. People trusted it because it existed physically and could not be printed. But storing gold was dangerous and inconvenient. Goldsmiths offered secure vaults and issued paper receipts. Over time, people stopped redeeming the receipts and began trading the paper instead. That paper was easier to move than gold, and trust shifted quietly. Here's the critical moment most history books rush past, because this is where everything changed. Goldsmiths noticed that not everyone came to claim their gold at the same time, so they issued more paper receipts than the gold they actually held. This was the birth of fractional reserve banking. They created money out of thin air, loaned it, and charged interest on something that did not fully exist. It sounded risky, but it made them incredibly powerful. And the scariest part is that governments eventually copied this idea. When banks failed, people lost everything. Panic spread quickly, and economies collapsed overnight. To fix this chaos, central banks were created to act as lenders of last resort. The promise was stability and protection, but power always comes with conditions. Central banks gained control over interest rates, money supply, and economic direction. From that moment on, money was no longer just a tool of trade. It became a tool of policy and control. The gold standard tried to keep governments honest by tying paper money to physical gold. In theory, this limited reckless spending. In reality, wars made this promise inconvenient. During World War I and later World War II, governments printed money far beyond gold reserves to fund massive military operations. They told citizens it was temporary. History shows that temporary financial measures rarely are. After World War II, the world adopted a new system where the US dollar was backed by gold and other currencies were backed by the dollar. This made the United States the financial center of the world. It worked smoothly until the costs of war and social programs exploded. Foreign countries began demanding gold instead of dollars. The vaults started emptying, and panic crept in behind closed doors. In 1971, the US quietly ended the gold standard. Overnight, money became fully fiat, meaning it had value only because governments said so. No gold, no physical limit, just trust. Most people did not notice because life continued normally. But this moment was one of the biggest financial shifts in history. From that point forward, money could be created without restraint, and debt became the fuel of growth. Credit cards, mortgages, student loans, and corporate debt exploded. Credit made life feel easier and richer, but it came with chains most people did not see. Borrowing from the future became normal. Governments borrowed trillions, companies leveraged endlessly, and individuals lived beyond their means. Everything looked stable until cracks began to form. And when they did, the fallout was devastating. The 2008 financial crisis exposed how fragile the system really was. Banks packaged risky loans into complex products and sold them as safe investments. When borrowers defaulted, the entire structure collapsed. Millions lost homes and jobs, yet the banks were rescued with taxpayer money. Ask yourself this: if the system failed, why were the architects saved while ordinary people paid the price? Central banks responded by printing unprecedented amounts of money. Quantitative easing sounded technical, but the effect was simple. More money chased the same goods, pushing asset prices higher. Stocks, real estate, and bonds soared, while wages lagged behind. Wealth inequality widened dramatically. Those who owned assets benefited. Those who depended on wages struggled. This pattern is not new. It is repeating history in slow motion. Inflation returned as a silent thief. Prices rose gradually, making everyday life more expensive. Food, housing, healthcare, and education costs climbed faster than incomes. Governments blamed supply chains, corporations blamed costs, and central banks promised control. But the root issue remained untouched. When money is easy to create, its value is easy to destroy. Digital banking and cashless payments made money even more abstract. A swipe, a tap, a number on a screen. Convenience increased, but so did surveillance and control. Transactions became traceable, accounts could be frozen, and access could be restricted. The question is not whether this power exists, but how it might be used during the next crisis. Cryptocurrencies emerged as a response, promising limited supply and independence from central control. Supporters called it financial freedom. Critics called it speculation. Both sides missed the deeper point. Crypto is not just about technology. It is a protest against a system built on debt and trust without limits. Whether it succeeds or fails, it reveals a growing loss of faith. History shows a repeating cycle. Money begins as a solution, grows into a system, becomes a weapon, collapses, and is rebuilt with no promises. Each time, the tools change, but human behavior does not. Greed, fear, and power drive decisions. The names on the coins may change, but the game remains the same. Wars accelerate these cycles. Conflict demands spending, and spending demands money creation. Inflation follows, trust erodes, and citizens pay the cost long after the war ends. This is not theory. It has happened across centuries, continents, and cultures. The real question is whether we recognize the pattern before it repeats again. Modern economies depend entirely on confidence. As long as people believe money works, it does. Once that belief cracks, systems unravel quickly. Bank runs, market crash, and social unrest follow. Trust takes decades to build and moments to lose. That is the hidden fragility beneath the surface of everyday transactions. Failed fixes often make problems worse. Price controls cause shortages. Bailouts encourage risky behavior. Printing money delays pain but increases long-term damage. Each solution buys time at a cost. The bill always comes due, and it is rarely paid by those who benefited most. Understanding money does not require complex math. It requires recognizing incentives and power structures. Ask who controls money creation, who benefits from inflation, and who bears the risk. The answers are usually uncomfortable, which is why they are rarely discussed openly. Here is the uncomfortable truth. Money is not broken by accident. It is shaped intentionally by those who understand it best. Complexity protects power. Confusion keeps people passive. The more abstract money becomes, the easier it is to manipulate without resistance. So where does this leave you? You live in a system built on centuries of experiments, failures, and compromises. You cannot opt out entirely, but you can become informed. Awareness is the first layer of protection in a world where money quietly shapes every major decision. The first takeaway is that money is a tool of power, not just exchange. The second takeaway is that debt-based systems create growth today by stealing from tomorrow. The third takeaway is that trust, once lost, is nearly impossible to restore. The warning is simple but serious. Systems change slowly, then suddenly. Stay curious, stay informed, and never assume money is neutral or harmless. Meta Finance Lab brings you useful knowledge and insights to help you understand the world of finance. Subscribe to stay informed and share with others who need this information.